The market is closed for the weekend. The final print for Beyond Meat, ticker BYND, at the 4 p.m. bell on Friday, November 7, 2025, was $1.39. That price represented a staggering 16.81% gain on the day, a massive spike on huge volume that had speculators and retail traders buzzing, looking at a chart that seemed to finally show a definitive bottom. But that is not where the story ended. In the after-hours session, the other shoe dropped. The stock plunged, falling over 6% to $1.30, wiping out a significant portion of that spectacular daily gain in the quiet of the post-market. That after-hours move is the entire story. The 16.81% rally during the day was the expectation, the hope, the narrative. It was the belief that after falling from highs above $200 to literal penny stock territory, a combination of high short interest and a few bits of good news, like a recent Walmart distribution deal, could ignite a historic squeeze. The 6% drop after the bell was the reality. And the reality is that Beyond Meat is a company in profound financial distress, and the news that came out explains exactly why that rally was a trap. The expectation was a squeeze. The reality is that the company just told the market it needs more time to figure out just how bad its numbers are. Here is what actually happened. That 16% pump was running on fumes, on speculation, ahead of the company's third-quarter earnings. But Beyond Meat then announced it was delaying its earnings release, pushing it from November 4th back to November 11th. Why? The company stated it needed more time to, quote, quantify a, quote, material non-cash impairment charge. In plain English, the company has assets on its books that it has to admit are not worth what it said they were. And the hit is so big, they haven't even finished the math yet. This is happening under the shadow of an active securities fraud investigation looking into whether the company's leadership already knew about and misrepresented the value of these very assets. So while retail traders on X and Reddit were cheering the intraday spike, the company itself was preparing to tell the world that its financial foundation is cracking. This brings us to the short seller thesis, which has been for the better part of 2 years absolutely correct. This is not just a case of firms talking a stock down. This is a case of institutions betting against a business model that is fundamentally broken. The short interest in Beyond Meat remains extremely high, with recent data showing around 51.8 million shares held short. While that percentage of the float, around 14.5%, is lower than the truly eye-watering levels seen in October during the brief squeeze, it is still a massive bet against the company's survival. The bear thesis is simple and has been proven right quarter after quarter. First, demand for the company's high-priced products is collapsing. In an inflationary environment, consumers are not trading up to expensive plant-based alternatives, they are trading down to cheaper store brands and traditional, less expensive proteins. Second, the competition is brutal. Not just from its direct rival Impossible Foods, but from giants like Tyson and Kellogg, who have their own cheaper plant-based lines. And third, the financials are a disaster. We don't even need to wait for the delayed Q3 numbers to see the damage. In the second quarter of 2025, net revenues fell off a cliff, dropping 19.6% to just $75 million. The company's gross margin evaporated, falling to 11.5%. It posted a loss from operations of $39.9 million. This is a company that is burning cash just to keep the lights on. Its balance sheet is even more terrifying. The company has negative shareholder equity to the tune of over $670 million. That means its total liabilities are $670 million more than the entire value of its assets. And that is before this new material impairment charge, which will wipe out even more asset value and send that negative equity figure plummeting further. So, let's look at the actionable side of this for investors. When a stock has high short interest, many new traders only see the potential for a squeeze. They look at the borrow rate, which is the fee to borrow shares to short. During the October spike, that fee skyrocketed to over 45%, putting immense pressure on shorts. But as of Friday, that rate was back down to a very manageable 3%. The pressure is off. Then they look at days to cover, which was recently as low as 0.40. This figure is wildly deceptive. It's calculated by dividing the number of shares short by the average daily volume. Because of the recent speculative frenzy, the volume has been enormous, 143 million shares on Friday alone. A low days to cover number is supposed to mean shorts can exit their positions quickly. But this misunderstands the short sellers' motive. They are not trying to exit. They are holding on and winning. The company's own earnings delay and impairment warning is the ultimate validation of their thesis. They have no reason to cover. They have every reason to add. This is the tension that plays out in these dying meme stocks. The retail expectation is a coordinated us versus them fight against short sellers. But the reality is that the shorts are often just the first to do the homework. What's your take on this? Are the shorts just correctly identifying a broken business? Or is this pressure preventing a recovery? The evidence overwhelmingly points to the former. The company's recent debt restructuring, where it swapped $1.15 billion in debt, was not a sign of strength. It was a move that led to massive dilution of existing shareholders, creating even more shares to dump on the market. Let's briefly step back and remember what this company was. Beyond Meat was supposed to be the future of food. It had a star-studded IPO and major partnerships, or at least trials, with McDonald's, KFC, and Starbucks. But those partnerships have largely fizzled or been scaled back. The product was a novelty, but it failed to achieve its most important goal: price parity with traditional meat. It remains a premium, niche product in a market that is demanding value. The brand that was once a darling of sustainable investing is now fighting for its life. Looking forward, the picture is incredibly bleak. The next major event is the delayed earnings call on November 11th. The entire market will be listening for one thing: the size of that impairment charge. This will tell us how much of the company's supposed value was illusion. From there, the risks are clear and present. The most immediate is a NASDAQ delisting. The stock closed at $1.39 and hit $1.30 after hours. If it breaks below $1 for 30 consecutive trading days, NASDAQ will send a delisting notice. The only way to fix that is usually a reverse stock split, which is a cosmetic maneuver that almost always precedes further price collapse. The second risk is very simply insolvency. A company with negative equity that is burning tens of millions of dollars every quarter is on a path to zero. Comment below if you've ever traded Beyond Meat. Are you holding it, or did you get out after the recent volatility? The analyst community has made its opinion clear. The consensus rating is a strong sell, with firms like Mizuho setting price targets as low as 80 cents. In the end, this is a classic story of expectation versus reality. The expectation on Friday was a 16.81% signal that the squeeze was back on. The reality was a 6.5% slapdown confirming that the company is fundamentally broken. The speculation was that a Walmart deal could save it. The reality is that the company is drowning in debt, its sales are in freefall, and it's about to write off a huge chunk of its remaining assets. The story for Beyond Meat is no longer about growth, it is about survival.